Thank you for joining me. This is the Morning Market Review with myself, Russell Shaw. I'm the Senior Market Specialist at FXCM, and my email address is rshaw@fxcm.com. Today is Friday. It's the 26th of August, 2022. I'm just going to bring up the high-risk investment warning. Go through this very quickly. Yeah, I was saying we should have shorted the webinar. All right, I hope it's not an omen. All right, here's the market commentaries disclaimer. I'll keep this on screen for a few moments. And I'm just going to bring up our references. We actually did the CNBC article, so we won't go into that, but I'll bring up the US dollar. And I just want to go through a few key points for today. I think that today is going to be a tricky day in the market, and for obvious reasons. We've got the keynote at 4 p.m. ZA, 3 p.m. UK. That's going to be the Fed Chair Jerome Powell, his delivery at Jackson Hole. Global markets are looking at this. We're all very anxious, right? There has been already some sort of hawkish bias that has emerged. We had, I think it was Daly speak yesterday, and she suggested tightening. There was also Bostic, I think, outlined hawkishness ahead. But it really comes down to the Fed Chair's communication, and the markets, as we see on trading view over here, I think do have a hawkish tilt to them, but it can change very quickly. So why do I say there's a hawkish tilt? Well, just taking a look at the zone analysis, looking at the data chart. So the two main charts, we've got the dollar at the top, we've got the real rate in the middle, and then the correlation. We're going to go down to the hourly in a moment, but you can see the daily chart is in zone 1 in terms of rates. The dollar chart is in zone 1 in terms of rates. We're just going to go down to the hourly chart here. And this is very interesting. So the dollar is maintaining some sort of bullish tilt on the 1 hour. Rates kind of in neutral as we move into the European Open. And I think if we get a hawkish delivery, we're going to see the real rates jump from the neutral, which is between the two blues. I think it's going to jump into the bullish, which will be the upper blue, upper red. And I think we'll have liftoff with a greenback. Having said that, if there is some sort of surprise in terms of a Fed pivot, well, then the logical section would see rates drop into the lower blue, lower red. That's our bearish channel, and we'll see the dollar come down. I am of the opinion that the Fed has to fight inflation. I think that it's at real risk of spiraling. I don't think there's a spiral yet, but you don't want to get to the point when you're fighting a spiral, and you've especially seen that, I think, in wages. So just to explain what tends to happen with wages is, well, we all go to the grocery store, the supermarket, and we can see prices have increased it quite drastically. Energy prices in Europe are exorbitant at the moment. So what we'll do is we would go to our employer and we'll say, you know, our standard of living has dropped. We can't keep the same standard up. I need a raise. And then the employer would either say yes or no, but let's assume that they say yes. Well, then they've got to pass on the extra costs to to their consumers, right, to their customers. Well, if they're passing those costs, then the next time you arrive back at the grocery store or wherever, you'll find that the goods are more expensive anyway. Even though you've got the increase, okay, it hasn't benefited you because your wage increase has been passed on back to you, and you get caught in the spiral. And that's a very dangerous place for an economy to be. So, and I think that needs to be addressed by the Fed, and not just the Fed, central banks in general. The UK, we saw that report come out, City, suggesting an 18% inflation. Central banks are extremely mindful of their price stability targets, and given that there is a fairly strong job market, we haven't seen it capitulate just yet. I think that the logical course for a policymaker would be to induce some sort of pain in the economy to bring down the dangers of a price spiral. That's my view, subject to correction. And I think that the Fed needs to actually be quite steadfast here. So in other words, the whole market is looking at the Fed chair now, and we're all banking on a communication that is effectively a strong communication. And I think that if Jerome Powell sort of blinks here, I think that there is an opportunity that is going to be missed, because Jackson Hole has been a platform where strong decisions have been made in the past. So Ben Bernanke announcing his quantitative easing, the movement, as we said yesterday, from an absolute to an average price target. So this is kind of the opportunity, and it would just seem to me, before we get the communication, in my opinion, that the Fed chair needs to take it. So we'll watch this with, very, very carefully. It's going to be a volatile delivery, because there is scope for a pivot. And if there is a pivot, I think the market is going to be quite quick to adjust. And that adjustment would be in the rates come down, dollar come down, the majors get supported by that. I would suggest the stock market gets supported by that, because the risk adjustment rate, the risk rates would be adjusting downwards. But that is in the event that there is a surprise pivot. If there is quite a forceful delivery, and if the Fed chair says there has to be some sort of adjustment in the labor market, unfortunately there has to be some short-term pain for long-term gain, I think that would be bullish for the US dollar. I think then we'll see the risk rates adjust upwards, and if those risk rates adjust upwards, I think risk markets come down. So you're going to see the usual suspects. Nasdaq would react very quickly. The cryptos would very quickly, and I think the majors would react very quickly. I think gold would react very quickly, because the ripple effect here is going to be quite broad. So this is an important chart, but of course there is a whole lot of uncertainty that is attached to it. Now, I just want to bring up the euro. So I'm currently short euro. Okay, so, and I said yesterday I was looking for I was looking to get into a short position, and I am short at the moment. I've been holding it overnight, and I am flattered, to be honest, because I'm not sure if I want to be holding this over the delivery. And to be honest, I think that the more prudent approach would actually be to close out before the delivery, just in case there is a Fed pivot. I don't think there will be, but do I want to really use my money on that? And the truth of the matter is, no, I don't. I really don't. So I would probably close out before the delivery. But you can see the reason that I went short here. So I just want to discuss this with you because it, I think, is a good example of what we're trying to achieve in the webinars. So let me bring up Microsoft Paint. We've seen this many times, but I think it's worth bringing it up again. And just delete that. We would get a sense, okay, of the primary trend. Which way is the market really heading? And the primary trend is really a function of fundamentals. So there's going to be volatility within the primary trend, and that would be completely expected. So we would, in a bull market, see these secondary corrections, okay, and that's what Dow theory calls them, secondary corrections. Okay. But overall, in a bull market, we must be moving up, because otherwise it's not a bull market. So whilst we don't move up in a straight line, we do have something that's very important to acknowledge here, and that is the impulse, which is the movement in the direction of the primary trend, should be stronger. Let's do the impulses in black. The impulses should carry all the weight, because without the stronger impulses, we're not going to get from the bottom to the top. In other words, the pullbacks should be relatively short-lived if we are in a bona fide bull market. Okay, so the green are your corrections, your black are your impulses, and together they chart out the primary trend. Similarly, when we look at a bear market, we would see the volatility there as well. We'll see ebbs and flows, and that is just the normal behavior of the market. It could be for a number of reasons. It could be that some news comes out that is positive within a bear market, that causes a rally. It could be profit taking, that causes a rally. There could be all sorts of reasons that are inducing the volatility, but markets are inherently volatile, right? But within that volatility, there should be some sort of sense, let's say order. I think more chaotic than orderly, but we basically refer to it as the heartbeat. So there'll be some sort of heartbeat in the way the market moves up. There'll be a heartbeat in the way that the market moves down. And again, just looking at these corrections, theoretically, the corrections in a downtrend, the bear market rallies, sucker rallies, whatever you want to call them, dead cat bounces, but they should be relatively short-lived in comparison to the impulse moves. The impulse moves must be stronger, otherwise we're not going to get from the top to the bottom. So we've got to try and come up with some sort of reasoning. I'm firmly of the belief that we must come up with some sort of fundamental reasoning of why the primary trend is up, or why is the primary trend down. And I think once we match up the fundamentals with the technicals, we, in my opinion, are better off than most market participants, because we can attach a sense to what's happening in the market. And I think that's the approach we want to adopt today. We have a very tricky market today. I want to make this green. Okay, we have a very tricky market today. And is there really a fundamental reason why we would think that the euro moves down? Is there fundamental reason why we think that the US dollar should move up. And that's the way I think that we need to be looking at the market. Here's the primary trend. Okay. The head and shoulders, obviously, we can take out. That's been completely invalidated. Okay, so let's take that out so we don't have the confusion. And I think the whole story comes into the Fed. It comes down to the sort of the mantra, which was made famous by a fund manager by the name of Marty Zweig, and he said, "Don't fight the Fed." Okay, and the idea here is the primary fundamental reason that is behind the primary technical trend is we don't want to fight the Fed. The Fed's tightening. Okay, the communications have all been about a tightening market, but they haven't been so clear. There has been some ambiguity in the communication, which I think has been unnecessary. For example, some of the FOMC members say different things on the same day, and that just introduces an ambiguity. That's why everybody's looking now at Jerome Powell, because he's the linchpin, right? He's key. What he says goes. So that's and it's at a very important platform. So we need to fight inflation. There's no doubt about that. This is the perfect platform, and not only have we got a tight conventional monetary policy, we've got a tight unconventional monetary policy that is quantitative tightening. And as that plays out, the primary trend seems to be moving that northeasterly direction. And what have we got here? We've got impulse and then a moderate correction. Okay, just like we saw. I should color code it sort of black green, but I just did. Impulse, so that was a good strong impulse. Moderate. Okay. Impulse. This one's tricky, but it's actually moderate now that it's in hindsight, right? There was a lot of fog in this last pullback. Couldn't quite figure it out, and there was that tricky head and shoulders that looked as if it might complete. It never completed, but it was borderline completing. And it looks like we kind of, yeah. But again, it's not good enough just to understand the peaks and troughs. What's the fundamental reasons behind those peaks and troughs? And I think that a lot of technical analysts neglect the fundamentals to their detriment. I think a lot of fundamental analysts neglect the technicals much to their detriment. Let's just examine this candle over here. Okay, so this is a very, very interesting candle, considering that we're in Jackson Hole. And I think it is an appropriate candle before the Fed delivery. I think that the way this candle ends today is going to be a completely different candle. It's either going to be a red candle, quite a heavy red candle down, or it's going to be quite a long blue candle up. I'll see, if that opinion is right. We'll see that on Monday. But once the Fed chair makes his delivery, we will have clarity. Then the market can move. The market hasn't moved this week. We've got a very, very indecisive, uncertain candle on this dollar chart. What we've got here is effectively called a doji, right? So we've got bulls that have tried to front run by pushing price up. What does front running mean? It means they're trying to get ahead of the news. You've got bears that have tried to front run, trying to get ahead of the news, going down. Neither of them know if they're right or wrong. So there's some sort of balance there, and we're quite flat actually for the week. So the idea here is the market's uncertain. Quite correctly, they're uncertain because we all got opinions on what the Fed chair is going to say today we've got an opinion on that Tony is going to take, but we're uncertain. And that's really a reflection reflected in this candle. We go through to our euro US dollar. Okay. So not quite as much uncertainty in the euro, and I've got an opinion for that as well. There is some sort of support that has come in. What I think is happening here with the euro, I think quite interesting and important. We had the ECB's minutes come out yesterday, and they were really poor. I really thought they were poor minutes. The ECB talks a good game and then is also blinking. So what am I saying? Well, we had a very good communication a few months back on a blog post on the ECB website by President Lagarde, really laying down the path of normalization. And of course, the economic conditions have changed. But I think the communication has to change with the with changing economic conditions. So in the minutes are pointing to more rate hikes in Europe, which I think makes sense to a degree. But then now Europe's facing a recession, which has to be considered as well. Will the ECB make the tough choice or not? We'll wait and see. But the minutes hardly refer to recession. Couldn't quite fathom what I was reading. They used the word recession only a handful of times, but they used the word contraction or pullback, or so they use other words as opposed to recession. In other words, it looked very much as if they were just burying their head in the sand, not acknowledging. So the way that I read that was, well, they don't really have the scope. They don't really have the scope to cut because they haven't even acknowledged the recession yet. In other words, the communication's got to be tighter. There's got to be the communication's got to be to the point where we have to implement tight policy. There's going to be a adjustment on the labour side of the market. The adjustment on the labour side of the market means that there is going to be an economic effect. It's necessary to reestablish equilibrium, and I just don't see that communication coming through. So what happened is that the minutes came out, there was a spike. The markets kind of started reading through the minutes, saw how poor the communication was, and they just faded the euro. Okay, so that's why I think there's less uncertainty on the euro side of things. But again, this is going to be a very different candle after the delivery at Jackson Hole. It's either going to be a red candle, quite a vicious red candle down, or it's going to be a very bullish sort of hammer on the way up, right? It's going to be one of the two, which didn't really help us as traders because we're kind of sitting on the fence. But that's exactly why I'm probably going to close the position. I mean, prior to the trade, because I don't know which candle is going to be after the fact, right? So that's the market that we're in. We would just want to take a look at the DAX. And the DAX here is the DAX here does actually have a bullish candle here, but we know that there is a lower peak, lower trough, lower peak. What's happening here? Again, this candle is going to be remarkably different after the delivery. And the reason for that is because of the time value of money, right? I just want everyone to sort of, we're not going to use complex formulas, but I think everyone must just start getting used to this very basic formula for the time value of money. Let's put dividends over here, cash flows, okay? And we're just going to put 1 plus, we'll just call it interest, okay? Interest rates. And this is going to equal index value or share value. I mean, it's very, very simplified in terms of, but it does the job, this. So what he's saying is that one way or the other, there's going to be an adjustment here I guess, as the talk is delivered, interest rates are either going to be moving up, going to be moving down, whichever way they go, okay, index value is going to theoretically be moving in the opposite direction. So if interest rates are adjusting upwards, okay, index value comes down. Okay, if the interest rates go up, sorry, if interest rates go down, beg your pardon, index value goes up. So the question is, why would they be moving opposite to one another? Well, the reason is this is the index value over 1. Just to kind of, in other words, the index value is a numerator, so it's on top. Interest rates are a denominator, so they inversely related to one another. So that's why they would move in opposite directions. We are, for the time being, ignoring the cash flow item. But I think that's appropriate for now. So again, if we see the interest rates go down, I think we get a very positive blue hammer here. If interest rates go up, I think we get a much more bearish red candle. So again, how do you approach the DAX trade? Very carefully, very carefully. I think the point's be made. The uncertainty is there. Uncertainty means risk. Higher risk means if we're approaching the market, we've got to make some key choices. Do we want to be in the market at the time of delivery? My personal preference would probably be out. I think I'll close my position sometime before. But if you are, it's going to move very fast. Whatever stop loss you put in, it will be hit, it will be triggered, but it won't be triggered at the stop. The prices are going to move very quickly through the stops. So you need to factor that slippage into your positions as well. So lighter positions, okay, lighter positions, if you are thinking of taking on the risk. All right. Any questions around that? I'm so sorry about this morning, just with the first 10 minutes, it kind of threw me a bit. But if there's any questions, please go ahead and type those in. I'll edit this video. I'm going to take out the first 10 minutes and then I'll put it onto Telegram. Oh yeah, let me just see here. Is this one of those trades where the impulse will be faded after an hour back to the current rates? That is a very good question, Rod. Of course, I wish I had the answer for that. I don't believe so. Let me just think about this very carefully. I don't believe so, subject to correction. I think that there is going to be a strong movement just because of the potential energy, the potential that's sitting on the sidelines. So just in terms of the sort of the transfer, so it will become potential kinetic, and I think that there is a lot of build-up. That's my opinion. Where there could be a fading, so if the Fed chair is hawkish, I'm of the opinion there'll be volatility. So we'll see we will see aspects of fading, but I think that overall those faded movements also gets supported. But what could be interesting, Rob, is perhaps if there is a pivot, a Fed pivot, so maybe there's a sharp movement down, perhaps that gets faded because we've still got the QT in the background. So the fade, I think there's a greater chance. So if the dollar, so what I'm saying is if the dollar shoots down, I think that may be bought. In other words, that would be the more logical faded move, in my opinion. If there is a movement up in the dollar, I don't think that's going to be faded. Again, I'm going to have to tag on subject to correction because I really sort of, I'm just obviously giving an opinion. I can't tell you factually, but so I think the chance of if there is going to be buyers, if there's going to be any fading, I think it's going to be on it's going to be longs at much lower levels. Does it help at all, Rob? It's very very broad, but I could only be broad with that question. I hope that's okay. Any other questions there, guys? I have to tag subject to correction because I just don't know. But yeah, I think we again try and tag the fundamental situation on. Also, just by the way, PCE is coming out today, so we'll see what the inflation number is with the PCE. I think that's going to be interesting as well. All right, I think what we'll do then is let's wrap up here, and we will chat on Monday. So have a good and interesting day for us. Have a good weekend, and then we'll chat Monday morning. Thanks, guys.